Assalamualaikum and hi to our beloved lecturer, Madam Hadaliza. Today, me Nur Amira Syairah binti Sapian and my friend gonna be present about the mock trading report analysis. This is our group members which are Nisa Najwa binti Muhammad Zaki, Nur Syafiqah binti Zulkafli, me as Nur Amira Syairah binti Sapian and Nur Azmina binti Muhammad Ramis. For the first, I will start with the introduction. Based on the individual analysis that we have made, we have finalized the best 1 stock per person and we have chosen the best 4 stock that can generate significant profits relative to all the stock. For the company Emulus Holding Berhad, which has been chosen by Nisa Najwa, is involved in the design, engineering and development of ATE. Next is MMAG Holdings Berhad, which has been chosen by Nur Syafiqah as a consultancy and management services. Moreover, the Atronic Berhad, which has been chosen by me, is a company that focuses on the information and communication technology, ICT industry by providing cutting-edge services and ICT products. Lastly is the stock from APB Resources Berhad, which has been chosen by Nur Azmina, is involved in the fabrication of process equipment for the oleochemical, oil and gas, energy and petrochemical industries. Next, I will pass to the next presenter.
Thank you, Amira. My name is Nur Syafiqah binti Zulkafli and I will present about task 2. Based on the data that we have collected from 4 selected stocks which are from Emulus, MMAG Holding Berhad, Atronic and APB Resources Company. From the data, it shows that the highest main return is from Atronic Company with 0.32480661, and meanwhile the lowest main return is MMAG Holding Berhad with negative 0.0654446324. For the variance from the data, it shows that the highest variance is from Atronic Company with 15.9457758. And the lowest variance is APB Resources with 1.417233356. Next, for standard deviation. From the information, the highest standard deviation is Emulus Company, which is 3.04166667. The lowest standard variation is from APB Resources with 1.5306122245. For coefficient of variation, the highest is from Emulus Company with 40.53586774, and the lowest coefficient of variation is negative 26.34498604 by MMAG Holding Berhad. Next, I will pass to the next presenter.
Thank you, Syafiqah. My name is Nur Azmina binti Muhammad Ramis. Next, task 3 requires us to justify which portfolio combinations are the best and discuss the effect of risk and return on a portfolio as compared to if each stock is being held as a single asset. From the data shown on the screen, it shows that the best portfolio combinations are MMAG Holding Berhad and APB Resources because they have the lowest covariance value and correlation coefficient compared to the other pairing, which is negative 0.4507122857 and negative 0.01748761297 respectively. Portfolio risk is a chance that the combination of assets or units within the investments that you own fail to meet financial objectives. Each investment within a portfolio carries its own risk, with higher potential return typically meaning higher risk. Portfolio standard deviation is calculated based on the standard deviations of returns of each asset in the portfolio. MMAG Holding Berhad and APB Resources Berhad have the lowest standard deviation among the 4 chosen companies, which are 1.72413791 and 1.5306122245. It shows that both companies imply less volatility and more stability in the returns of portfolio, and is a very useful financial metric when comparing different portfolios. The coefficient of variation allows investors to determine how much volatility or risk is assumed in comparison to the amount of return expected from investments. MMAG holding behind APB Resources have the lowest coefficient of variation among the 4 chosen companies, which are negative 26.344, 98604, and 6.58359671 respectively. Ideally, if the coefficient of variation formula has resulted in a lower ratio of the standard deviation to mean return, then the better the risk-return trade-off. Next, I will pass to the next presenter.
For the conclusion, correlation risk and return with two asset portfolios are dependent on the proportion of each asset, the standard deviation, and the correlation or covariance between the assets' returns. A positive correlation exists between risk and return, whereby the greater the risk, the higher the potential for profit or loss. The perfect negative correlation implies that when the return on one asset is rising, the return on the asset is falling. The most diversified portfolio consists of securities with the greatest negative correlation. In light of the fact that stock with a negative correlation can completely eliminate all the investment risk, while those with a positive correlation have a higher level of risk. Thank you.